there. Welcome to Indian Open right here on BloombergQuint Live. I'm Leader Shah. With me is Devina, and it looks to be a day where we might have some bit of a pullback. Devina, good morning. I won't be surprised, frankly, if we see a bit of a pullback in the session today. We're still awaiting that big stimulus package from the government of India. But the fact that the markets have retreated due to other factors notwithstanding, but the global markets have come off a bit, and we do not have any domestic factor to sail us through. After the rally, maybe a pullback could well be on offer today.
Well, that's what at least the rest, and good morning, Neeraj, and that's what the rest of the globe is also indicating. Yesterday, you did have all the US equity markets close in the red, though the cuts were not all that steep. And today morning is an indication that we are going to probably see an opening in the red as well. So across the board, Asia is also down out. We've got the SGX somewhere around 9,080 odd. That's also pulled back a bit. And the focus is going to remain on what happens to crude oil prices, because that again and again we've been saying that there has to be a slight marginal pickup in the prices of crude if the confidence is to come back into the equity market, because that is what showcases demand, and which is completely missing from the system. And what happened yesterday with regards to crude oil prices may be specific to the May contract itself, because the spot prices are in deep contango with the June and July prices. Brent prices are also stable. So the May contract on the back of concerns of storage in Cushing. But aside from that, it also gives you an underlying message that the demand is completely getting cut out. So all of these factors kept in mind, equity markets in focus today with Infosys and the kind of numbers that it reported.
Yeah, well, let's wait and watch what happens to some of these. Actually, just before we get started with a very big global voice, I think it's important to just take care of these domestic factors as well. We'll start off lower, we know. What will Infosys do in that light, simply because the stock had run up so much out of its numbers? Agam Vakil joins us to give us a quick snapshot of Infi results and, well, commentary, and maybe did Infi do better than TCS? Agam.
Neeraj, as far as Infosys is concerned, well, I'm going to start off with the earnings here, and we are largely looking at inline set of earnings when it comes to the revenues, which actually declined around 0.3% in dollar terms. In rupee terms, we saw a slight uptick of around 0.8%. Again, margins did see contraction, and I'll tell you why in just a bit. I'm going to start off with the top line. The company has had very strong deal bookings, not unlike what we saw in case of TCS, and yes, they have seen a higher cost related to transition to work from home, which is why the margins have come in under a bit of pressure. But the most important factor, I suppose, when it comes to Infosys is the fact that they have once again temporarily disbanded their provision of giving an annual guidance as well as operating margins. They say that they are not ruling out that they will give a guidance in the upcoming quarters, but for now they are choosing not to give so because of extreme uncertainty with respect to the pandemic. But on the whole, we've already put up a copy and compared Infosys earnings along with TCS and Wipro, and largely all three companies have come up with earnings which are in line. And again, more importantly, the outlook for all these three companies is also very, very similar, considering TCS has already said that it's going to see a sharp decline in terms of its revenues, as well as Wipro also suspending quarterly guidance for the time being.
Doesn't surprise. It does tough times. Thanks, Agam, for putting that into perspective. By the way, I must also tell our viewers that, and I would ask Mahesh Joshi about this, that also impacting sentiment on IT, if not actual, is Donald Trump's tweet saying that in light of the attack from the invisible enemy, I will be signing an executive order to temporarily suspend immigration into the United States. So lots happening within new world orders as we speak. Since we're on the topic of IT and this Donald Trump tweet, let me ask Mahesh first about that, then we'll talk about crude, and then at some point of time in the show, we'll also get in Yu Young from Aberdeen to talk about his thoughts. Mahesh, good having you. Thanks for joining in. Good morning to you. How do you view what Infi, TCS, Wipro have done in light of the current circumstances, and Donald Trump saying immigration likely to be suspended? Does it have any meaningful impact on IT?
Morning, Neeraj. Thanks for having me. So first of all, I think the results that have got posted and the expected management commentary, I think much in line in what the analyst expectations were. So I think it's rather inconsequential in terms of the numbers being posted in terms of the Q4 performance and the expectations on the annualized basis with guidances coming off, or rather not getting disclosed at this point of time. So largely, I think all the levers that we probably talked about for the sector as a whole, margins clearly seem to be under pressure at this point of time. The obvious reasons are the miss out in terms of billing days at this point of time, uncertainty in terms of discretionary spending for the large sectors that they cater to, specifically in terms of BFSI, retail, manufacturing. And what happens, as you rightly pointed out, I think the executive order that has probably come through, I think the on-site part, which is very, very critical for IT, though I think a lot of de-risking has happened over a period of time and a lot of revenues have shifted more on the digital mode as digital contributes quite significantly. The hit might not be that significant because I think there are alternate options that can be done. But again, I think the execution and what probably happens in terms of the levers from the margin, specifically an EBIT margin perspective and cash flows thereof, I think that still remains a question mark for the better part of this year. So I think the downside that you probably expected to see for IT, which can be very, very sluggish considering the end user industry performance, as well as the levers required for utilization levels across the sectors that they operate on. I think that is going to be very, very critical. So yeah, I think it's sort of a dampener, but the stocks are trying to pencil that in. How the recovery happens, I think the earnings recovery is largely penciled in on the second half. So I think the next 2 quarters are expected to be, at least in an Indian context, be very, very soft. And that is clearly being reflective even in terms of how the TCS management put forth that they're relating that this scenario, very, very similar to the global financial crisis of 2008. So I think, yeah, watchful times for IT in terms of discretionary spending.
Yeah, the other point also being that much of this growth that they're penciling in for FY20 now comes in the form of inorganic growth. Therefore, if you take a look at pure organic performance, probably it's in line with TCS. And the fact that the commentary that came out from the management pretty much mirrored what the TCS management spoke about in terms of demand. The weakness seems very broad-based, and both Infosys and TCS, being the behemoths that they are definitely going to be banking on their delivery track record. They're going to be banking on the fact that they are able to swiftly, pivot to remote working to get them additional clients as well. So let's see how that shapes up in terms of winning orders for them in the near term. But definitely some vendor consolidation happens. For the oil marketing companies and for the upstream companies as well, today is going to be an important day considering the flux in crude oil prices, leaving the aberration of the May contract on the WTI. The inherent weakness in crude demand is definitely going to weigh down on oil prices, physical oil prices as well, for a foreseeable future. What do you see then for some of these companies?
So, Devina, again, what has happened specifically overnight, and the adjustment thereof, and I was hearing Dheeraj's piece in the morning as well. I think all the concerns related to that and oil futures, again, on the WTI part, on the June contract, pointing towards a range of $20-25 odd. So, yeah, I think the kind of fall that you've probably seen, and it's largely a correlation in terms of how the overall Brent prices move at this point of time. So upstream companies which have a direct correlation in terms of how Brent moves are clearly going to feel the effect. It's not that they have not felt the effect so far. I think the kind of fall that you've probably seen is a clear reflection in terms of the earnings pressure that is expected to come through and trickle down right from the top line, right till the bottom line as well. So yeah, there are obvious concerns that are obviously getting played out. The other spectrum of this thing is valuations as well for the upstream companies. Valuations are cheap, dividend yield is fine at this point of time. But again, I think it's a very difficult call in terms of whether cash flows can be at sustainable levels for the better part of this year.
Okay, got that. Stay on with us, Mayuresh. We're coming right back to you. But bringing the most important voice of the day, then, Yu Young, head of Asia Pacific Aberdeen Standard Investments, is joining us right now on the phone line from Hong Kong. Yu, great to have you, and thank you so much for taking out the time. Before we get on to this conversation, the big elephant in the room, that is crude. Obviously, May was one specific contract because of the issues with regards to storage and Cushing. But the fact that you've seen an agreement with the OPEC plus allied nations on a production cut, that has still not managed to put in any confidence with regards to supporting the prices of crude. Where do you see this headed now from here?
No, it hasn't. Really an indication that the global economy has slowed tremendously. As we know, airlines aren't flying, et cetera, et cetera. So it's likely that oil prices are likely to be weak, certainly short term, and remain weak, which is, of course, generally a net benefit for oil importing countries such as India. But as your previous speaker mentioned, the real issue at the moment is storage, because oil is being pumped out of the ground every day, and there's simply nowhere to put it at the moment, and it's not being consumed.
Do have our own domestic, oil marketing companies, out of storage and maybe putting a hold on lifting those additional contracts that they have in place. But, aside from that, let's talk about, the big unprecedented environment that we are in and created by COVID-19, especially for global equities and emerging markets in particular.
Yes, it's created a really rocky environment where all markets have reacted in tandem. If anything, developed markets in certain cases have been weaker than certain emerging markets. Obviously, China being the prime example of a market that's held up surprisingly well, despite being at the center of the virus initially. So for us, it's certainly very heightened uncertainty. We're waiting to see earnings announcements for the first quarter, where you'll see a big impact, and it's affecting all industries. From financials on through. So it's going to be a rocky period until the virus goes away, and that doesn't look imminent. Although the good news is that it seems to be stabilizing in certain countries, but of course at a very heavy economic cost. So this year essentially is going to be a write-off for much of corporate earnings, and the key thing to focus on, of course, is strength of the corporates, i.e. the balance sheet.
In light of that, do you feel that the markets are factoring in all these negatives that are still yet to unfold? We're talking about the economic costs, global economic costs, the IMF putting out their outlook for global growth being negative for a lot of countries. But the equity markets have actually managed to bounce off their lows and, in fact, move into bull territory. So do you feel that markets are a little ahead of themselves in terms of reading into the actual impact of this crisis?
Yes, I think in many ways you're right. So the markets are certainly out of sync at the moment with the actual economic reality that's hitting many companies very, very hard. Of course, that is in large part a reflection of the amount of money that governments have pumped into the system, and of course markets do look ahead in theory, so they are looking towards the recovery, and one should certainly be looking out there to put money into markets when they have such sharp falls. But the sharp bounce that we've seen is that a little too soon and too strong? I would say yes, it probably is. Certainly too strong. One expects bounces after sharp falls, but it's been a very, very strong bounce, and one would expect markets to pull back and reflect the economic reality. But of course, we live in very strange times, and with government intervention, that puts another big question mark over things. So what you think is logical doesn't necessarily happen.
You just want your sense on, obviously you've got central banks across the globe, citing that they will do anything that is required to make sure that the damage is cushioned in any shape and form to the economy. But what does that do for their own balance sheets? And how do you think that comes on the mend then? Because you've seen how inflated the US balance sheet is, the US central government balance sheet is. It's just not sustainable. And how do you think that will play out then? And does that open a new can of worms later on?
Yes, it has. Although, to be honest, we were all saying that the government balance sheets, certain government balance sheets, such as the US, haven't been sustainable for years, but they keep on expanding and expanding them. And it seems a never-ending piece of string that they're able to pull, or elastic that we're all expecting to snap at one day, but hasn't yet. So I think it certainly creates complications, big complications. Some governments still have that flexibility and aren't in a complete mess. But you could argue that the US and certain European countries are getting that way, which creates another can of worms to be sorted out later in the day. And that's obviously what governments are thinking. Well, we go ahead and do this. It worked in the economic crisis of, now over 10 years ago. Let's keep on doing it. So it seems to be the response to all types of crises.
It certainly is. Yu Young, good morning. What's your India view currently?
Well, I guess, again, India, a bit like the rest of the world, we're waiting to see what the effect on earnings of the lockdown is. We're waiting to see what stress there is in the financial system, and really it's been the financial system in India that's probably worried us the most over the years. Not particularly to do with coronavirus, but of course at times like this you then see the weaknesses that we all knew existed potentially exposed. So that's certainly one of our concerns, which obviously is a market's concern, because we've seen financials pull back quite sharply.
Yeah, indeed. In fact, I was going to ask you that, Yu Young, a bit of a micro question, but you've been a long-term investor into some of these marquee India financial names. Do you believe too that this time is different than the rest, and therefore should the investing theories around Indian financials change?
Well, whenever people say this time it's different, one should always be very wary. History does have a habit of repeating itself, but I still think the strong Indian financials are the right place to be. The issue really has been, and has been for a few years, is that the ratings on the quality financials, the HDFCs, HDFC banks, Kotaks of this world, have just been very, very high. So any potential hiccup in the economic outlook, and we're seeing more than a hiccup, is of course an excuse for those prices to fall. And the valuations to fall, which they've been doing. But I still think for our portfolios, but it makes sense to maintain the exposure, because providing you're in the quality names, these are the right places to be to enjoy the economic growth going ahead when we get through this.
If this was a few months ago, pre-COVID-19, these companies would be companies that you would want to own at any price, any valuation. Now that there is this correction that has come in, prices have come back down a little bit to realistic numbers. Do you feel that the next rally are still going to be in the form of these financials? They're going to take charge and lead through the front, obviously keeping in mind that they're still the most heavy-weighted stocks in most of the indices.
I think they probably will. I think one has to wait a bit just to see the outlook for the economy, because they're obviously very sensitive to that. So any hint of debt crises and the like, of course, will hold them back. But the strong professional private banks, I think, will weather those storms. So should lead a rally, or should at least participate in a rally. If they don't lead the rally, I mean, people at the moment have been taking refuge worldwide and in India in consumer goods as being the steady earners. But I think when confidence picks up, people will refocus on some of the financials.
What about the non-banking financial companies then? That's where the trouble point is. That's where the pain area is. Correct.
And I think that's a sector one always has to be very, very careful with. And it's the lower end, more volatile end of the market. So an area one has to be very, very careful in. Simply because, well, again, the financial system in India is far from perfect, and when you're down at that end of the system, it makes it a lot more vulnerable.
Okay, just one last question and a two-part question. One. When is the time when an investor or a company such as yourself starts looking at pumping in a lot more money in a market like India, which FIs have completely pressed the pause button on currently, and which sectors then stack up in terms of a favorable risk-reward ratio to make that kind?
Pumping a lot more money into India depends on two things. One, either us having money coming in the door generally, which most financial institutions, I suspect, are not seeing money in. And then the second, and in that case more important point, is how India stacks up compared to other markets within your universe, whether it's a global universe, an Asian universe, or a global emerging market universe. And certainly as far as quality of companies is concerned, India holds up well. And it has some of the some excellent companies in all those universes. So the issue then is valuations. So it's going to be very much on valuations and what the markets look like at the time. And India, for us, for quite some time, has been a very attractive long-term market. But we've had issues over the valuations of India, with India doing what it's done recently and falling sharply, albeit rebounding a bit. It's certainly brought the valuations back far more within our area of comfort. So I think India will see its fair share of cash going in, if cash comes back into the system and into equity funds generally. And certainly India, relative to China, in recent months has become a lot more attractive because of the relative moves of markets.
That's definitely an interesting point to hear on a comparative basis to China. Thanks, you. Really appreciate you taking out the time and hope to speak to you more often. Thank you so much.
Many thanks.
Thank you. That's Yu Young there, head of Asia Pacific Aberdeen Standard Investments there, talking about how India can get its fair share of the money considering valuations come off, but you need to see things moving on ground.
Yeah, well, let's get in our focus a bit on India trade. Mayuresh has been waiting by patiently, Mayuresh, but I would urge you to just be a bit more patient with us, because I think we've got our technical experts on board as well. And 5 minutes before open, we need to get a quick perspective from them as well. Let's start off with Rajat Bose Johnson right now with his thoughts. Rajat, good having you. Thanks for joining in. Thanks for your patience. Let's make it quick, Rajat. Slight paucity of time. What's your approach to trade this morning? What's the index strategy?
Regarding the index, I would say that if it were to open below 9070 and sustains there, then I would put a stop loss above 9190 and take a short trade. The first target, of course, is 8900, and after 8900, it can slide down to 8815, and thereafter 8700 would be the level that I would be looking at. And chances are that the downtrend is likely to be sustained today. The most critical level in today's session would be 8900 on the downside and 9190 on the upside. If 9190 is taken out, then we can expect further upside. Otherwise, any rally towards 9190, if it fizzles out, then also sell with a stop above 9325. So generally, today I'm expecting a downside. Similarly, for the bank nifty, I would say that if it were to open say around below 2400, then 2325 is the first target, and you put a stop loss above 2672 and go the short there. You can expect if 20,000 gets broken, then 19,800 could be the target for Bank Nifty. Bank Nifty, there could be a lot more selling today than in the Nifty. Of course, if the IT index underperforms, then there will be a lot of carnage in the Nifty as well.
Yeah, and keep in mind, I think Rajat Bose's long-term view or slightly medium-term view, long-term is open to its interpretation right now, is that we'll head lower, and we'll revise that call with him as well. But Amit Harchekar, quick opening thoughts. What's the today strategy on the indices?
Well, we continue to maintain a very positive stance on this market. So we are buying this fear. In case market opens gap down lower, we will add long positions. We have an overall short-term target of 9600 on the Nifty because we think this is a long accumulation which has happened in last one and a half month. And we think any dips to be bought into, we are looking that around 9000 to 9050 becomes a very strong support for the market. So that should be the area one should go long. 8900 is the stop loss we are suggesting for the long futures for a short-term traders. But positionally, we are have a very positive view. We are seeing Nifty going beyond 10,000.
Wow. Okay, Amit is playing contrarian yet again. He used to do that when we were at 12,000. Interesting thoughts right now. Gentlemen, we'll take in your opening strategies in a bit because there is only as much time left right now. So we'll take both the stock calls in moments from now, post the pre-open session. Watch out for that. Mayuresh Joshi, one very quick word on Bajaj Finance. 30 seconds. UBS has come out and downgraded. A bunch of others have done that. If you had Bajaj Finance in your portfolio, would you get out of it or would you stay put?
No, I think most of the damage, Neeraj, has been done for Bajaj Finance. So what happens going forward is largely expected to be a strong earnings recovery in the second half. So if I'm still holding on to that, even after this massive fall, I'll continue holding on to that stuff.
Okay, continue holding on to Bajaj Finance. Today is going to be an important day from the perspective of what happens to some of these oil and gas companies. And SGX Nifty pointing towards a slower start, so that's what you can expect. Slight lower open this morning. Dow futures, S&P 500 futures trade lower as well on the back of Donald Trump's tweet on pausing immigration for some time. And the currency, once again, that saw a little bit of weakness in yesterday's session, comes back into the focus. And Infosys, on the back of the results that met street expectations, but again, commentary did not give a guidance, saying that the impact in demand is broad-based. It's definitely going to take some time before everything comes back to normal, maybe even extend. Pre-open on your screens, you've got a dip on the Nifty and the Sensex of about 3.5% now. So that's a huge slash that's coming in, sub 9,000 for the Nifty 50, and that was anticipated looking at what the SGX Nifty was doing. Big cuts on ONGC, that's your top loser right now. That's down about 10-odd%. And what else is down? Bajaj Finance. Bajaj Finance is showing a cut. ICICI Bank this is 6.5% up. But again, Reliance Industries is down 4.5%. TCS 3.5% under. HDFC Bank down 2.5%. Remember, you do have a UBS note which has slashed Bajaj Finance's target price 1,600 rupees. So that is something that could be weighing down on the prices of Bajaj Finance, with a big slash in target price cuts. Remember, Bernstein had already put out its note. It had earlier slashed its target prices by 50%. And coming next is UBS with their target price cuts. HDFC Bank I already spoke about. Vedanta, Sun Pharma,
Devina,
HCL.
Yeah, Devin, I just want to mark some other mid caps as well, because that's where we're seeing the larger fall. So watch out for India Bulls Housing Finance, non-Nifty, that is down about 13-14%. Carborundum Universal is showing signs of a 14% downtick. So actually do watch out for those names. And mind you, the crude price fall impact on stocks like ONGC is visible for now. Let's see if these rates change, but looks like starting off weak. The key is we're actually seeing some gains in some of the banking names like UCO, Central, J&K, and J&K Bank has been on a bit of a roll. Let's wait and watch. Let's give these rates a chance to settle down, and then we will talk more about these. But the South Korean won has stumbled, but the rupee hasn't. 76.54. I don't know if the belief is that the currency or the oil price fall does aid the sentiment out there, but it looks okay for the time being. We'll revisit these rates once the pre-open rates settle down. For now, let's get in those ideas from our experts. Rajat, I would want to come to you first in light of your view, and we'll get to your long-term view in a bit, Rajat, but in light of your near-term view, which is that there could be small upside also and there could be a potential downside also. What are the stocks that you're recommending for the day?
I was earlier looking at if the index were to take out that 94 50 kind of range, then probably we would have headed to 98.80. That is the 50% mark of the total fall. But now the situation is that today's day is very crucial. If we fall below 8,900 and close there, then there is this rally is capped. Whatever high you have made in the recent past, that's about it, and we are headed down again. And But if suppose you were to choose a stock that you would play on the long side, I would say these oil marketing companies, they are in they're in a strong uptrend, at least in the short term. So you look at HPCL and you buy with a stop loss of 224, 232, 235 are the two targets, and if 235 is taken out, then it could be headed for 240. Of course, that's a tall order. And if you have to sell, you can sell something in FMCG, something in pharma, something in metals. So I've chosen one metal stock which actually whose chart mimics the Nifty Metal Index. It's Hindalco. I would put a stop loss above 119.10, 112 and 110 are the targets. And for one, I would say that this was a pullback rally, and the pullback rally is getting over. After you hear Mr. Pawan Goenka telling the media that it would take 3 months for him to actually start the operations in full scale, we would see a lot of problems going forward. I'm not really optimistic that immediately we would really go up. And one thing I would like to point out here is that I would still avoid financial, including the marquee name that you just discussed.
Yeah, actually, everybody's avoiding that. I don't know if you mean avoiding shorting it, but everybody's avoiding going long on it for sure, Rajat. Amit Harchekar, what are your stock recommendations for the day today?
Well, I have come out with the 2 buy calls because we have a very super positive view on the markets. First call is buying Reliance Industries. We think this stock has confirmed a strong long-term bottom, and we are looking for a target of 1450 to 1500 on a very short term, because 1150 was a major resistance that has been taken out with very strong volumes. So we are recommending buying at the opening levels. The stop loss we are recommending is 1140 on a closing basis. Our second pick would be buying Bpcl futures. Here the rationale is the BSE oil and gas index is still poised for an upside of around 35 to 40% even from current levels. So in case there is a marginal dip in Bpcl, again, it's a good buying opportunity. The long-term breakout has also got activated above 365. So we would suggest keeping a stop loss of 353, and we are looking for a short-term target of 400.
I just want to quickly run you through some of the changes that UBS has done with regards to a rating outlook as well as a target price cut. So I already spoke about Bajaj Finance, where they've downgraded the stock to a sell. Target price is down from 4,600 to 1,600 on Bajaj Finance. They've also downgraded Ujjivan Finance. They've downgraded to a neutral. Target is 400 from 450. HDFC Limited target has been pushed down to 2,100 from 2,850. Shriram Transport Finance saw a downgrade from S&P Global Ratings as well, and now UBS also has downgraded it, and 1,000 is the target price from 1,650. Then you've got M&M Financial Services, 230 from 500, L&T FinServ from 165 to 80, and Equitas from 160 to 60, and LIC Housing Finance from 475 to 300. So NBFCs across the board, target prices have been slashed. Mayuresh, you want to comment on that and the kind of dent this entire space is witnessing?
No, so you need to give it time, Devina, as I've been saying time and again. What has happened in terms of the expectations of the loan growth actually deaccelerating for most of these firms, what happens in terms of the moratorium period announced, which clearly gives a lag in terms of the cash flow management and the asset liability mix as well. The third, obviously, is the pressure points, which are very obvious put out in terms of unsecured lending, SME lending, so on and so forth, which has a say in terms of both reported numbers on the GNPA side, close stage 3, close stage 2 and 3 as well as the provisioning required for the same, which also has a train in terms of both an impact on the cash flows as well as how the capital adequacy stacks up. So capital adequacy is still very, very reasonable for the top-notch players, but what happens with all these parameters actually drag their earnings down. So I think we'll wait out for the numbers because I think the first half is going to be extremely soft on all these parameters for this space.
Yeah, I mean, for Bajaj Finance, any which ways you can expect, some bit of normalcy to come back only towards the end of this calendar year, since the lockdown anyways got extended. The other one I want to talk about is the Deepak Nitrite. Now, this one comes into focus because, as per Finance Ministry notification, the anti-dumping duty imposed on acetone imports from countries like China, Saudi, South Korea has been extended by another 6 months to about October 14th. And this is in order to protect the domestic market. And Deepak Nitrite here is a bigger player and a definite positive for Deepak Nitrite on the back of this anti-dumping duty on imports of acetone. You want to come in, Mayuresh?
No, so if somebody's holding on, clearly hold on, because this is one stock where we have been extremely positive. Obviously, I think it maintains a huge leadership position when it comes to phenol and the byproduct acetone as well. So any news related to this, as you're mentioning, is obviously a huge positive. What also happens is the clear transitionary trend that we are seeing in terms of all the three segments that they operate out of, basic chemicals, performance chemicals, and specialty chemicals as well. So all those three in terms of performance has done exceedingly well. This quarter and next, also the impact might be there on earnings. But the rebound in terms of a shift from the Chinese market, de-risking from export-oriented customers as well, both from the European and the American markets, I think that does hold good for Deepak Nitrite. Yeah, so anybody holding on clearly should hold on to Deepak Nitrite.
The other interesting one, of course, would be Reliance Industries. Yesterday was a big surger, but today, because of the oil price drop, has clearly started off lower. Let's wait and watch if it shows some gain in an otherwise very dull market. I know Amit Archekar has a long call there, but it'll be interesting to see what this one does. I'm interested in knowing both fundamental and technical view on Bharti Airtel. There is paucity of time, so quick thoughts here. First, Rajat Bose, a quick view if you can. Bharti Airtel, it's shown some weakness the last 3 or 4 days. What do you do here?
Bharti Airtel, I would say that there is a critical level of 490. If it were to fall below that, then at least a 10-point downside to about 480 is there. But 480, a cluster of moving averages are there in between 480 and 470. So if that support gets taken out, then there would be further fall. But if you look at the last 4 days of price activity, this clearly suggests that the upside has been capped already. So now we have to see whether the support levels hold or not. So 480 to 470 is definitely the range you should be watching out for.
Okay, and keep in mind, we'll take it a fundamental from Mayuresh Joshi as well, but it's 9:10, that time of the show. We're going to tell you all that you need to know to stay ahead in trade today. So let's first do that. All eyes on India's oil and gas space as crude oil prices recover from being in negative territory, but overall show a substantial downtick.
Infosys reports muted earnings in Q4. The company temporarily disbanded its practice of giving annual revenue growth guidance and operating margin guidance on account of uncertainty due to COVID-19.
ACC and CRISIL will be amongst the key companies to announce earnings today. ICICI Prudential Life has deferred the earnings from today's announcement.
European Union clears Reliance Industries deal with British Petroleum, reports Bloomberg News.
Morpen Labs receives license to manufacture hydrochloroquine from State Drug Controller last week for its Baddi plant in Himachal Pradesh.
UBS turns cautious on Indian NBFC asset quality and loan growth, believes lockdown in urban areas could be longer than May 3rd, and an economic recovery, particularly in the services sector.
Well, we'll watch out for these names. So do watch out. NBFCs we've discussed a lot already. Mayuresh, a quick thought on Bharti Airtel. Rajat spoke about the technicals. What about the fundamentals? Is this a corrective move which gives you a chance to buy? Because the common refrain is everybody's using data in a big fashion, so telcos will naturally benefit.
Oh yes, I think that's a given right now, right, Neeraj? So I think everybody is on to data consumption in a significant manner. They've also taken tariff hikes. So I think these elements obviously work in favor for Bharti Airtel. But the cash drain is very, very evident even now. Yes, it's comparatively better placed compared to our Vodafone Idea. I think the capital raise that they've done, the AGR dues, and what they've probably deposited at this point of time, even in terms of their self-assessment, I think that's all fine. But what comes forward is also the capex requirements. They've cut down capex quite significantly on a year-on-year basis, but the capex will still continue. How they probably bid in terms of the new 5G, whether they do that or not in terms of pricing. And again, I think all the refarming needs that probably come in terms of circle approvals that come for renewals, along with what happens in terms of their broadband businesses. So I think the cash flow drain is definitely there. But yes, I think from an earnings perspective and a data consumption perspective, with the tariff increases, cash flow improvement is there to be seen for Bharti Airtel as well. So yeah, this is one stock that I'll still probably hold on if I do have that in my portfolio.
All right, 2.5 minutes left to go for market open, and at the end of pre-open, we're down about 2.5% for the Nifty, while the Nifty Bank's down about 3.5%. And yesterday's big, cup that came into ICICI Bank has extended into today's session as well. Similarly, related to exposures to an oil and gas company, which is likely to go bust, and therefore the stock in yesterday's session towards the end of the closing saw this big steep cut of 4%. And today as well, you're seeing a 5.5% drop on ICICI Bank. Rajat, you want to quickly come in, ICICI Bank?
Yeah, ICICI Bank now looks pretty weak. In fact, my feeling is that it can actually head down further from here. And if it were to move below the current levels of 341, then 335 would be the next target, but definitely watch the level of 340. That is the level where some support is likely. If that level is taken out, then 335 to about 328 on the downside, that you should be watching out.
Okay. Mayuresh, before we let you go, quick 30-second answer. Anything that you feel you're likely to buy, not in maybe bulk, but create an SIP in?
No, so David, I think we still remain extremely constructive on the pharma space. Yes, it's a consensus trade, but earnings will still hold up. The retaliatory actions will actually bode well in terms of approvals being seen for a lot of Indian pharma companies. So Alchem Labs from the mid-cap space looks very, very interesting. The Indian and the US business should hold up. The pipeline is pretty strong, and balance sheet probably looks far more sturdy at this point of time.
We leave it at that, Mayuresh. Alchem Labs is a choice that Mayuresh has within the pharma space. Let's quickly get in the top ideas. We're under a minute left to go for market open. Rajat, I'll come to you first. Your top trading idea.
Sorry, you are asking me?
One top call for the morning.
Well, I would sell Dr. Reddy with a stop above 3,900 and expecting a target of 3,750 or so.
Okay. Well, Rajat, take a moment to thank you for joining in today and giving us your thoughts. Amit Harchekar, I would request you to stay on because the markets are about to start, so I'll have to take your top call post-market open, and then we'll get in Rajesh Kothari as well on the show with his thoughts from AlfAccurate. But here's how the markets are starting off, about 2.77% lower, so it's not a great start. In fact, we are very close to the 3% now mark for the Sensex, and the Nifty Bank is down about 4%. So it's starting off as per script. The point is, can it continue? Well, while ONGC is down 8%, need to mark Bajaj Finance down 7.5% amongst the top losers. I reckon a part of the reason would be the UBS target price cut. The financials are well regarded. and that stock is down about 7. But I must say, some of the other NBFCs, by and large, would be under pressure. I'm sure Devina will mark them. GAIL starts off 6.5% lower. Again, the oil price casualty. There is weakness in Vedanta, weakness in Hindalco. So the global commodity stocks are suffering today. Tata Motors down about 4.5% after the big gains, I think on Friday or yesterday's session actually. Not a single index stock in the green. That's the key thing. Dr. Reddy's and Bpcl and Power Grid. Power Grid in the green now, but Dr. Reddy's and Bpcl are the other two, just managing to hold out. HUL marginally, Sun Pharma marginally, but essentially the long and short of the index chart is that there is not a single stock in the green, all Nifty 50 stocks in the red, and financials taking a battering. I must say, Devina, autos are also giving them company.
Yeah, auto also because of the fact that, most of the OEMs have said that they're really not looking at starting any production till the lockdown gets completely lifted, because it's not a function of getting labor to do your work, it's a function of getting supplies. And unless you don't have everything in place, it's just, the expense to income ratio goes, off whack, and therefore you don't want to really start production with a 20-25% capacity if you don't have supplies in place. The other one within the broader market space, obviously, today's session is seeing a little bit of a sell-off there, as well as in some of these auto ancillaries too. So this is a company which up until now has seen a decent run-up on the back of all the positive news around it. The stock is seeing a correction of about 7.5%. Then you've got GAIL, which is down about 7.5%. The Supreme Petro is down 7%. Ashoka Buildcon too did well in these last few days. Last week did really well. Today is down about 8%. Oberoi Realty, Vodafone Idea 6% under. PVR continues to grind lower. The problem with PVR is there is still no visibility. We spoke to the management of Inox and they said that they are going to start social distancing within the theatres. But it's about the confidence of the customer to really come back into crowded places, and when that happens is another question. Indiabulls Housing Finance is down 5.5%. The likes of DCB, Equitas, Solar FinServe, all of them down under. L&T Fin Holdings also remember the impact of the UBS target price cuts on some of these MBFCs too. Infrastructure names are down, Sterlite Tech is down, Marks & Pharma is down. So everything across the board seems to be weak. The only thing that's doing okay are the likes of an EID Priory, which is up 8.5%. And then you've got Future Lifestyle that's up 5%. Future Retail is also up 5%. So future growth stocks are taking a little bit of a breather in this downturn after the incessant selling that they've seen earlier on.
Yeah, well, and Amit Harchekar, we kept you on purpose. Before we get to Rajesh Kothari, and he's been waiting patiently for us as well. Rajesh just requested to stay on for a minute longer. But Amit, you were bullish. Would you use this dip? Would you go out and use this dip to buy? And what's the top call for the day today?
Yeah, we are quite positive, and I think this dip it's again a good opportunity to go long. As I said, we are looking for a target of beyond 10,000 in coming weeks. So I think from a very short-term perspective, 8,900 can be kept as the stop loss for your long positions. For today's trade, the top pick would be buying HUL. Overall, we have a target of around 2850 for Hindustan Lever, but on a very short-term basis, we are looking for a target of 2450. So for today's trade, the stop loss would be 2250 on a closing basis.
Okay. Well, thanks so much for joining in, Amit, and giving us your thoughts. Really appreciate your time. Well, let's get in somebody who looks at long-term business fundamentals to try and figure out how is it that he's thinking of buying anything right now, and if they are indeed thinking of buying. Rajesh Kothari joins in right now. Rajesh, good having you. Thanks so much for joining in. At the outset, let me ask you, are you sitting on any cash in your client portfolios right now, anticipating any falls, or are you fully invested?
Neeraj, basically we reached around 18 to 22% cash levels in the client's portfolio. Of course, this is for the old clients. For new clients, we are having significant cash. But then what we did is that about roughly 6 to 7% we redeployed into the market, taking advantage of correction which came, sharp correction which came in between. And right now we are holding, as we speak, roughly about 11 to 13% cash.
Rajesh, what happens to discretionary consumption in the current point? I'm not talking about staples, non-staples. Would you consider taking a bet because of the fall in prices, or are the valuations difficult to determine right now because you don't know what the earnings impact would be?
Well, I think Neeraj, it is very, very clear to us that in FY21 is going to be washout year for most of the companies, irrespective which sector we belong to. Yes, earnings can be 10% degrowth or 30% degrowth or 50% degrowth, depending upon segment in which you are present. So say, for example, if you are into specialty pharmaceutical, or if you are into FMCG, or if you are into agriculture-related company, then earnings degrowth might be mild. But any other segment, earnings is going to be, medium to high level. But what we have done is that for us, what we are now incrementally looking at is FY22, and we are asking very simple questions to ourselves that whether FY22 is going to be higher than FY20 or not. It's a very simple thing because there is a lot of noise around. Uncertainty is highest. Everyday markets are going to be either plus 2% or minus 2%, that too opening up with a gap or opening down with a gap. So you don't have time to act and react and act and react. You can't do that every day, right? So, very important question, fundamental question, whether FY22 is going to be higher than FY20. And if answer is yes, whether valuations are already pricing in, or you have some room for, further valuation re-rating whenever people start looking at FY22. And depending upon answer to that question, we position ourselves, well. So, irrespective whether it is even if it's discretionary, FY20 is going to be a very bad year. It is not about April. I think it is going to, normalcy will come back only from September or October. So FY20 is going to be a washout year for most of the companies, irrespective of which sector you are.
Okay. Rajesh, so should one anticipate, obviously, FY20 earnings are put on the back burner, but even FY21 earnings, while there will be a gradual recovery, it may not be up to scale, and therefore maybe investment decisions can be delayed a bit?
Absolutely, that's what exactly what I'm saying. That FY20, you should take FY20 as your EPS for FY22. If it is a good company, it can be a little bit higher. If it is a not that great company, it will be significantly lower. FY21 is going to be a bad year because your first month is gone. It is not only about first month, probably 45 to 60 days are gone. And from third month, you will see 30, 40, 50% utilization. And as we move towards September, you will see, coming back to normalcy very gradually. And this also, mind you, assumes a lot of things. So there is no point of looking at FY21 because point is how much pricing is already started discounting it. So market is always ahead of time. In fact, according to the Bloomberg Intelligence chart, market is roughly 200 to 300 days in advance to the corporate earnings bottom and GDP bottom. Market bottoms about 200 days before the GDP bottom and the earnings bottom. So don't look at FY21. Start looking at FY22. And there basically, if the company is good, high quality, good balance sheet, where you think that these people are going to believe them, investors, bankers, everyone, then that's the company which is worth looking at because there is a significant dent on the valuation for many of such companies. And as we come back to normalcy, people will start looking at, those companies.
Mm-hmm. Okay. What are you making out of, the interest within some of the defensive pockets, like pharma, obviously, because they are the epicenter of, this entire issue. Pharma being one, consumption, particularly staples, because that demand is not going to go away anytime soon. And some of these diagnostic companies, not just health, not just particularly pure play pharma, but diagnostic.
Well, there are four sectors actually, which are, I would say, a little bit less impacted. Impact will be there even to that companies, but impact is going to be significantly lesser. So first and foremost is pharmaceutical. Second is diagnostic chains, as you rightly mentioned, where the impact is going to be high for 1 or 2 months, but after that they'll be the first one to come back to normalcy. Then third segment is FMCG, that is staples. Then the fourth segment is agriculture related because we should remember that last year monsoon was very good, water levels are very high, crop is going to be much better. Also, the COVID-19 has less impacted to rural population. If you look at the number of districts and the population impacted because of COVID-19 is very low if you look at rural India. And there is one more segment, fifth segment, which is also going to recover very strongly, is the specialty chemicals. Most of the companies have already announced that plants are already operational because it's considered like an essential item. So these are the 5 segments where we believe the impact is going to be low to moderate. Of course, valuations of many of these companies are already factoring in this. They are no more cheap, but that's fine because it's going to be like that. So these are the 5 segments where, if you ask me, the impact is going to be lesser.
Rajesh, if my memory serves me right, you were bullish on some of the auto ancillary players. I don't know if that view changed 3 months, 6 months, 9 months ago, but they've seen a bit of a pullback on expectations that things could improve. We were speaking to Motherson Sumi and their commentary was very bullish. How do you think about this pack now? What do you think about, say, maybe a business like Motherson Sumi, which is exposed to so many global fluctuations?
Yeah, I think short term is going to be impact is going to be definitely significant for the entire auto ancillary sector, both global and local. But at the same time, if you look at a little bit futuristic, maybe 2-3 years, 5 years view, then the valuations of these companies have corrected a lot. Number one. Number two, increasing consolidation by the customers while doing outsourcing is going to happen, which is going to be long-term structural positive for companies who have capabilities, execution capabilities, and also balance sheet strength. So it is an interesting sector. We are not holding much of auto ancillary in our portfolio, but yes, it is an interesting space, and we are monitoring it very closely.
Okay. I wonder if you believe that this oil price fall could translate into some gains for the oil marketing companies. Is it a pocket that you're looking at? Divestment, oil price correction, and when lockdown returns, business would return?
I think, Neeraj, that thesis is there for entire market, that when lockdown reverses, everything will become normal, whether it is a consumer discretionary retail place or whether it is an oil marketing company. But for time being, as you must be aware that generally speaking, we avoid most of the PSUs in the space. And commodities also we generally avoid. We do not invest in commodity stocks. So we are not trading too much into this, the oil price crash. And therefore, looking into such companies for a short-term trade. No, right now we are not looking at that.
Okay. Anything that you're really convinced about or anything that you're really skeptical about?
Well, I think, our theme of 3M investment approach, market size, market share, and margin of safety, that theme is getting more and more validated in such tough times. Because whenever life is going to come back to normalcy, no doubt about it, it is a question of time, maybe another 10 days, 20 days, 30 days. And whenever that happens, the leaders, in our portfolio, because the entire portfolio consists of companies which are number 1 or number 2 or number 3 player in its own segment. And they all have either zero debt, it means zero long-term loans, zero short-term loans, or they have a debt equity less than 1:1. These companies are going to get significant benefit because of the consolidation in the industry. Many weak players are going to be out from the market. Bankers may not touch these companies. Many of such companies where the balance sheets are weak, it definitely is going to be disadvantage to them. So our portfolio companies have resilient business models with a very strong cash flows and under-leveraged balance sheet. So we are going to gain market share with 1 year, 3 year, 5 year standard perspective. And therefore, we feel, what I would say, rightly positioned for upcoming economy whenever economic growth and the earnings growth starts coming back. So it is not about avoiding space. Of course, we do not invest in commodities. We do not invest in metals, oil, and such companies and such sectors one should always avoid. And that again proves that why one should avoid, because you can't predict when the commodity price goes down 10, 20, 30, 40, 50%, and your stock price will be down probably 90%. You should avoid that space. That's number one. Number two, we should avoid any companies who have a weak management, weak corporate governance, weak balance sheet. And time and again, it is proven that, if you make any mistakes, then markets are not in a mood to pardon your mistake. And in such times, stocks goes down 70, 80, 90%. And therefore, it is a more of a portfolio quality and the resilient business model. I'm again using this word because not every company is a resilient business model. Think of a company which might be a great company, but 70% of its revenue coming from one particular market or one customer, and that customer is under problem. That business model is no more resilient, correct? So you need to look at the business model very closely, how resilient the business model is in terms of the cost curve, in terms of the diversification within customers, diversification within geographies, diversification within products, and all these things are very, very important. And then you start looking at the, building the portfolio. So that's again very, very important, the resiliency of the business model. And I think this time is again going to make some permanent change in the cost curves of many companies because companies are working very hard to reduce their cost further. And part of this cost cut is going to be permanent. And that can again boost the ROE of such strong business models.
That. Rajesh, it was great chatting with you. Thank you so much for joining.
Great. Thank you.
All right. And before we wind up, while the markets are looking dented this morning, we want to quickly update you on the latest numbers of infected cases here in India as of 8 a.m. this morning. So total confirmed cases stand at about 18,601, with the active cases being 14,759. So recoveries are really going up. Recoveries are at about 3,252, with the total number of deaths at about 590. So in terms of the last 24 hours, the new cases are about 1,336. The deaths are 47, while the recoveries are sharp at about 705. Well, on that note, while the equity markets are down almost 3%, that's all we have here on Indian Open. Thank you so much for watching. From Neeraj, myself, and the entire team that's put the show together.